Hello, everyone. This is Software Journey with Learn to Code with me. And today I want to just go into the topic of why I believe AMC and GME, so AMC and GameStop are very poor investment choices. There is the potential to trade them, but with regards to investment or value investment, in my personal opinion, I'm going to show my thesis as to why I believe they're poor investment choices. So let's go ahead and just take a look at some of the evidence. We're going to start off with GameStop, and then after we're going to transition over to AMC. Surprisingly, I believe GameStop is in a less worse position than AMC. AMC is you'll see in a moment that it's pretty drastic in the state that it's in, but we'll kind of view that. So I always like to save the most exciting for last, I guess. So with GameStop, we'll see as it currently stands, its most recent quarter. It looks like it had a net income of 147 million, or sorry, a net loss of 147 million. So that's a pretty sizable loss. Let's go ahead and take a look back, starting from this quarter. So here we could see that it lost about 60 mil, 100 mil, and the quarter afterwards 150 mil. So one thing that concerns me here is that it's not only consistently losing money quarter after quarter, but for some reason it seems that within the past 3 quarters, there seems to be an increase in that loss. Now I haven't looked into the particulars of the balance sheet, but that to me strikes concern, just because typically we don't applaud companies, or we don't see that as a good investment when companies are losing more and more money over time. Now that being said, let's go ahead and take a look at revenue as well. So here we could see that the revenue for GameStop was 1.2 billion to 1.8, or sorry, 1.2, around 1.2, 1.3 to 2.2. Okay, perfect. So there's increase in revenue. So that may be a case for GameStop. Now to kind of further delve into it, let's go ahead and take a look at the balance sheets. So here we see the balance sheet for the past few years. And we could, let's go ahead and just take a look at the patterns and see what's available. We can see that the book value itself, so it looks like in 2019, prior to the pandemic, was about, looks like $1 billion. Here it's about 600 million, 400 million, and then it shot up to 1.6 million. Now I speculate, right, and I believe this is true, that the increase in book value may be due to dilution. I do believe that for both AMC and GameStop, there were additional shares that were issued. And for this reason, you can increase the amount of cash that you have on hand. You can raise money unfortunately, at the consequence of diluting shareholders. So thereby reducing the stock price if the market cap were to remain the same. However, people can kind of keep following into the company due to momentum, and even with continual dilutions, you could still see the price elevate. A good example is, I believe, NNDM, or let's see. Well, actually, that's not too relevant at the moment, but we can see that the value did increase. Let's see if this is true. So here we could see the assets being 4 billion. Drastically reducing, I imagine, just because of, I don't know, the pandemic. They're not really making, once again, they're not really making any money, but they are losing money on with respect to having to pay their rents and having to pay their employees and so forth. Here it's reduced again to 2.4. And then here it's again, now this is where we have that breakaway. So from 2021 to 2022, that's where we have an increase in assets. Let's take a look at its debts, its liabilities. So it seems that reduction, part of it, at least 500 million in this case, from 2019 to 2020, could be due to paying off debt. But we can see that the total loss was roughly 1.2 billion. So that's $700 million kind of being lost as well, not directly contributing to paying off that debt. So actually more than what they paid off. So they paid off 500 million, but they lost about 700 million there. Let's take a look. So here we have 2.5, let's call it 2.5 bill to 2 billion liabilities. So here we see year over year, they decreased their liabilities by 200 million. So that makes sense. So from here, it looks like they didn't lose as much. So it looks like they lost about in assets 300 mil, and they paid off about 200 mil. So only 100 mil from 2020 to 2021. And then here from 2021 to 2022, we could see that they increased in about $1 billion in assets, and they were able to actually decrease by 100 million their liabilities. Okay, so that's good to see. Now with respect to their assets, let's see what's going on. So we could see, actually, no, sorry, I should say, yeah, with respect to their assets. Okay, cash equivalents increased. Yeah, so I suspect that was offerings that happened, and that's how they were able to increase their value. Let's see. That's good. Let's go ahead and take a look at another metric. Let's say, for example, common stock equity. Okay, so that increase, that does explain a little bit of what's kind of going on there. So actually shares issued, ordinary shares. Yeah, so quite a bit of shares offerings that took place. So one thing to consider is that with respect to it kind of losing money, in having consistently losing money over the quarters, increasing that loss over the past few quarters. And one other kind of metric that I always like to look at is based off of its book value, right? So let's go ahead and based off of its tangible book value, it's about 1.6 billion. We could see that net loss over the past 3 months or past quarter is 147 mil. So if we were to do 1,600, which represents the we'll think of it in terms of millions. So this is 1.6 billion divided by 147. We could see that, oh, sorry, actually, let's do it the other way. 147 divided by 1,600. We could see that they lost about 9% of their book value over the past 3 months. So that's a little bit concerning, just because at that rate in about 10 quarters, or about actually 11 quarters, let's be fair, in 11 quarters, which is a little less than 3 years, they would completely lose all of their assets unless they continue to dilute and produce share offerings. But once again, as an investor, that's, I don't know, unless you're kind of speculating that they're going to start to increase their profit, which it doesn't look like that's going in that direction. It looks like it's going the opposite direction. And I'm not sure why, someone may want to invest in this company. I understand that momentum is something that you may want to do, but in terms of value investing, it doesn't really seem like there's something there. Let's go ahead and transition over to AMC and see what we have in store there. So just starting off from, once again, actually, let's start off the most previous quarter. We can see that it lost sizable amount more than GameStop. It lost $337 million in the past quarter. That's pretty significant. Okay, let's see. Going back a few quarters, it lost 343 million. It lost 224 million, lost less money, but still lost 134 million. And then it just, once again, just lost triple the amount of value. So looks like there's consistent sizable losses that we see here. Let's see what else is available. Yeah, so that's something just to consider. Much higher losses. Let's go to the balance sheet. Let's take a look at their assets. So presently, so this past December, or at the end of last year, we could see that their total assets is 10.8 billion, but their debt or their liabilities is 12.6 billion. So that means that they owe much more. They owe more than they have. And so that's why we see the equity being negative 1.8 billion, essentially. So there's no real value. Like if this company were to, no real value in terms of if it were to liquidate this second, as a shareholder, you would receive nothing, right? You would be compensated nothing. I mean, there's too many obligations that it has, debt obligations that it has. There's really no tangible book value. It's actually, as we can even look at the book value these past few years, we see that it's just consistently negative. Doesn't really have any book value to it. So that's kind of concerning. Let's look at the past. We can see that it had 9.5. So 2018, it had 9.5 billion versus 8 billion in the liabilities. So there, at least it had some equity, shareholder equity. I'm not certain why the book value would be negative, but I mean, that's a little bit more positive. But we can see in 2019, that's where the liabilities substantially increased by 4.5 billion. Wow. And it makes sense. Well, actually, I don't know. I feel that may be pre-pandemic as well. So that's just astronomical amounts of debt that they issued, but actually their assets also increased by that amount. So I mean, it kind of cancels out. So you could see that the equity stayed relatively the same. I mean, it's a difference of 200 million, which is significant. Don't get me wrong, but I was curious. I was worried that was going to be a much larger number, or much larger difference. It's really in 2020 that we see the worst impact, and that's that you have only 10.2 billion assets and 13.1 billion liabilities. So that's where we start going into the negative equity. That's where if it were to liquidate, there's really nothing available. There's and for the next year as well, there's really nothing available. And so I'm not certain why any investor would want to pay a premium to have this company. Speaking of premiums, one way to kind of know what premium you're paying on a company. So GameStop, at least it did have a book value, right? So it did have a book value of 1.6 billion. And so we can take that relative to its market cap and see what the ratio is with respect to price to book value. So that's going to be price to book value or book ratio. There we go. And we could see that for GameStop, currently it's 6.54. So essentially this, you can think of this as a ratio of what you would pay for a Kelley Blue Book car. So this might be more familiar if you're into purchasing cars. Let's say, for example, you have a car that's $10,000. So let's say the Blue Book is 10K. Now, this company that has, it's intrinsically worth, let's say like $10,000, or a car that's worth $10,000. So that's what a fair price would be. You're paying about $65,000 for it, because you just multiply the ratio by the book value, and that's where you get 10 times 6.5. You get that $65,000. So imagine, would you realistically go into a car dealership, look at a car that's worth $10,000 and pay $65,000 for it, knowing that it's losing money every quarter? That's GameStop. On the other hand, AMC, you can't even perform that ratio because it doesn't have really a book value. It's negative. So there's nothing really you can do there. That ratio wouldn't apply because it's so far gone. So that's kind of my analysis on why I think GameStop and AMC are poor investment choices. Feel free to let me know why you believe this may be not the case. Please let me know your bullish thesis. I personally would stay away from these. This is not financial advice. I'm not a financial advisor, and I do this for entertainment purposes. I think people might find it interesting. At the same time, I actually just browsed the website StockTwits, and I was looking at some opinions, and sometimes I understand that people kind of may become emotionally attached to a stock, despite the losses, the net losses with respect to the company. I'm not talking about perhaps your own personal losses, but just the company itself losing money quarter after quarter. And I understand that emotional attachment, but at the end of the day, if you're not in the market to gain money, then that could be the case. If you just kind of do it for kicks, that's all good. But if you're doing it to make money, then perhaps it should be, and you're investing for the long run, then looking into companies that earn money, are profitable, or on the way to profitability is generally a good thing, generally something that investors look into. At the same time, I'm not going to say that the market cap and the share price can't go up. I believe it absolutely can go up. We can see a lot of momentum, a lot of hype a lot of FOMO, definitely have an impact on volatility. In the short run, yeah, sure, it can definitely go up in value. That's completely normal. But at the same time, I think over the long term, in statistics, we have a term called regressing to the mean. And that's that, over time, eventually, it's going to go to what it's worth, right? It's sure for the moment it can increase in price and it can have all of this hype, but eventually people are going to get tired of if these companies continue to have losses and people keep losing money because they keep getting their investment diluted, and perhaps worse yet, the company goes bankrupt, then that's when it regresses to the mean. That's when it goes back and shows its true value. That's not to say it may, GameStop and AMC might not turn it around, but I believe just looking from these values, it's very unlikely. Once again, these are my own personal opinions. Take it as you will. I really hope that you enjoyed kind of looking at these figures. Let me know if you have any questions. Thank you so much for watching. I strongly encourage you to like, share, and subscribe if you did enjoy it. I'll be pumping out more of this content as we continue. And I just hope to see you soon.